All right. Thanks for joining, you guys. Today, I'm going to break down how you can become a millionaire through real estate. Now, full disclaimer, I don't think the sole goal of becoming a millionaire should be, the backbone of your interest in real estate or other investing or any life goal. I think it's some arbitrary number that may mean the end all be all for someone and maybe a launching pad for someone else at their investment career, in their investing career going forward. They might want to achieve 10 or $100 million. It doesn't matter. But the real purpose behind this, as we've talked in previous episodes, is to achieve financial freedom. And once we achieve financial freedom, we free up our time and our money to invest in other things such as our families, and just we can do what we want, where we want, how we want, and so forth. So that's really the purpose of financial freedom. And you may hear that I think the majority of millionaires build their wealth through real estate. And I can totally see how, unless you have a very specific skilled labor, and you have a high dollar earner, and a lawyer, through medical field, and so forth, or really the biggest one, which is entrepreneurship and starting your own business and growing it from there. The fastest path to wealth and financial freedom for you and me is through real estate. So today we're going to dive in, and it's going to be a very specific breakdown. I'm not trying to sell you some type of class or get rich quick scheme. This can happen in a few years for someone who has more capital to invest today, or it can happen over 10, 20, or 30 years for other people. But regardless of that, this is a step-by-step plan with specific numbers and how to do it. And I'm going to outline it. It might take a little while, but stick with me if you're interested, okay? Because at the end, we're going to show you the exact amount of wealth we have built and how much passive income we have. And you're going to be surprised how easy it seems to get there, because it is longer term if you stick with the plan and take a short and midterm approach to building that long-term vision of yours, okay? So we will dive right in here. I'm going to bring up some slides. And I guess before we get into it, if you guys like videos like this, I do a lot of videos on personal finance, financial freedom, investing in short-term rentals, and break down things that may seem mysterious to us beginners. But please subscribe below, and it's free to subscribe. You just get notified when I post videos. I typically try to do at least once a week a new video. But all right, let's dive right in. So for the premise of this conversation, we are going to assume all of our investments are the same, and that's just, it's not likely. I mean, we may try to aim for this ballpark amount, but just for the sake of this conversation, it helps to have round numbers that are similar, and that way I can show you exactly how the wealth is built over time. Okay, so for this particular investment, we're looking at a house or a property that is $300,000, and we're going to assume a 15% down payment. And this could be your money, this could be you and a partner's money. There's many ways to get involved in real estate, but we're going to assume we have $45,000 to put down. Assume around $5,000 in closing costs and $15,000 to furnish it. And again, the furnishing cost could vary. It could be $5,000, it could be $20,000, depends what you want to put in there. And again, we're going to assume this is a short-term rental and a very conservative estimate. So this is our all-in investment of $65,000. I know that seems like a lot, but if it takes you a few years to save up for it, or again, if you go in on the investment with a partner, or someone else, a family member that also has interest in real estate, this is a good way to start. But we'll go ahead and dive in. So let's take this step by step. Don't stop watching the video because it seems like a lot of numbers and information. I'm going to break it down very, very simple terms. So year one, we have an investment, again, $65,000. We're going to assume that the property cash flows $800 in bookings a month through, again, Airbnb, VRBO, HomeAway, whatever platform you're using. And again, these numbers could probably be for a long-term rental as well. And you can see we get to cash on cash return. Anything above 10 or 12% is we're going to assume for a long-term rental. Short-term rentals could go up to 20, 30, even 40 or higher percent on cash return. So again, very conservative estimates. So if we have monthly cash flow of $800 for one property, that brings us annual cash flow of $9,600. Okay. And in previous videos, we talked about loan pay down and home appreciation, because we also have to take that into consideration as far as building wealth long term, not just our monthly cash flow. So in year one, if you go to a Google, okay, and look up amortization calculator and enter or loan calculator, you put in these numbers again, the $300,000, 15% down, and then put in an interest rate. I think I use 4.5%, and then it gives you your monthly principal and interest payments. And again, at the very start of your loan, there's a small amount going toward principal and the rest going toward interest, the majority of it going toward interest. Now, over time, the principal increases and the interest goes down. So the principal's being paid down, the loan's being paid down by your bookings to your guests. So we're making that additional, in this case, $345 a month on average the first 12 months. So that gets us an additional $4,140 a year in equity in the house. Now, depending what area you're in, the appreciation could be anywhere from 2 to 5% typically, sometimes higher, again, sometimes lower. But we use 3%. I consider that fairly conservative, especially if you're in a growing, city such as Nashville. So if you grow at 3%, again, on a $300,000 house, now you have around $9,000 more in equity in the house just from appreciation. So monthly, we're getting $750 on average from appreciation. So again, we go below here and we can see the cash on cash return. Again, if you're not familiar, we take the total cash flow divided by our total investment of $65,000, which gives us 14.77% cash on cash return. That's literally how much cash we made divided by how much cash we invested. Cash on cash. Get it? Okay. So 14.77%. Again, very conservative for a short-term rental. And we want to seek to achieve something greater than, let's say, 10%. Stock market between 7 and 10%, annualized growth per year. So we want to beat that in order to make it worth our time and investment. All right. And so now at the bottom, we have the total dollars earned. And again, I break it down very specific on a monthly and annual basis. So for monthly, again, that's $800 a month in cash flow, $345 on average for the first year per month in principal pay down, and about $750 worth of appreciation, bringing us to just south of $2,000 a month in earned wealth or earned money. And again, on an annualized basis, same thing. We just multiply those numbers by 12, and we get $22,740 in essentially earned wealth or wealth built through our first rental property in just year one. Now, the thing that we're going to be focused on the most here long term is going to be obviously equity in the houses, but the most important thing is cash flow, because that's going to enable us to grow, because each house we get, we earn more cash flow, and whatever savings we have from our current job is offset by our now investments. So now we can invest more dollars each year into one or more properties, as you'll see as we get into the next few slides. But total return on investment, guys, again, if you didn't watch a previous video, we take the total dollars earned, again, that $22,740 divided by our total dollars invested up front, and that brings us to a 34.99% return on investment, which is awesome. Okay? So for year two, we're going to assume we don't have enough money to buy a second house yet. So we're going to continue to save from our job, and we're also going to continue to collect on that cash flow. Again, remember, the cash flow was around $9,600 conservatively for the year. So we'll assume the same thing for year two. So the total amount we save from our rental property is $19,200. So at the end of year two and moving into year three, we're going to assume we purchase another property that is the same metrics, right? So the $300,000 asking price and 15% down and the same amount of closing costs and furnishing costs, etc. So now, we're going to assume conservatively $800 in cash flow from each unit. Now, this brings us to a monthly cash flow of $1,600. Again, multiply that by 12 months. Now we have an annual cash flow or additional passive income of $19,200. And now for principal pay down, you'll be able to see monthly in unit one. Again, I took the average of the 12 months for each year. And again, remember, each month for the entirety of your, let's say, 30-year conventional loan, the amount principal is going up and the amount you pay in interest each month is going down. That's the banks being smart and collecting their money up front. So in case you pay the house off early, they're making the majority of their money up front. So again, you're actually making more money each month in principal throughout the term of the loan, which is awesome. So again, for monthly, for unit 1, you'll see it's a little bit higher now, on average $373, and for unit 2, $345, bringing you to a total of $718 in equity pay down. All right, and that's annualized. Again, you can see below per unit, but a total amount for year 2, $8,616 just for year 2. All right, this isn't even including year 1. Again, if you remember, was that $4,140 also for the first property. Now, home appreciation. So this is where it gets really interesting, because if you have a $300,000 property, remember, if we grow at 3%, we're now at $309,000. And then for year 2, again, 3%, but you're not taking 3% of the $300,000, you're assuming 3% of the $309,000, which is the new value of the house. So you can see at the end of year 3 that at the end of year 3, the first unit that we purchased has grown $9,548 just in year 3 appreciation, okay? And then unit 2, again, we just assumed the 3% on the $300,000 for $9,000. So total from appreciation earned just in year 3, okay? This isn't including the year 1 and year 2 piled up. We'll get to that later on. But total from appreciation is $18,548. Or excuse me, that is including the total appreciation we've earned so far. But on a monthly basis, now we're up to around $1,546, which is awesome. So again, we continue the example. We look down at the bottom for the total dollars earned during year 3. Again, the same thing. We take it on a monthly and annual basis, but you'll see now we are earning a total of $46,364. That's combined from our cash flow, our passive income, and then principal pay down and appreciation with our 2 homes. So hopefully you're following along. Again, year 4, we're going to assume we're saving up again, and we're just collecting on cash flow from those 2 properties. So now with the 2 properties, $19,200 a year, it's starting to add up quick. You can see that snowball effect and how people, and this doesn't have to be in year 4. For some people, this could be year 2, and other people, it could be year 8. But the fact is you're moving forward, and you're going to see how it blows up over time, and you could start to accumulate serious wealth through real estate, okay? So total saved during years 3 and 4 adds up to $38,400. So year 5 assumption, we buy a 3rd unit. And again, with that $38,400, now it's not $65,000 out of pocket. It's much less, because we have $38,400, at our fingertips from our rental properties to invest in. So we're going to assume the same thing again, guys, okay? And I'm not going to go through an individual line item breakdown, but you'll see the total monthly cash flow is now $2,400, and our annual cash flow adds up to $28,800. And then the total principal pay down for the year would be $13,476, and then total from appreciation adds up to $28,678. So look down at the bottom here now, our total dollars earned through year 5, $70,954. Now year 6, again, we'll assume no purchases for this year, just to continue the same example that we've been working through. And now our cash flow is $28,800, and we're going to collect for 2 years. Now we've saved $57,600 to invest. Now here's what's cool, is you can either pretty much buy the next property almost in full just from the money you've earned through your rental properties, or you can buy 2 properties depending how much money you've saved up from your job the past 2 years. And now you're going to see it significantly snowball, okay? So if we buy 2 properties, now we have a total of 5 units, cash flowing $9,600 each annually. Again, this is pretty conservative for a short-term rental. This would be fair for maybe a long-term rental of this stature as well. And so if we have 5 units, our annual, again, we're going to focus on cash flow for the main part of this video, okay? So annual cash flow adds up to $48,000 a year. Now that could probably be very significant for a lot of us, okay? So at the end of year 7, again, we have 5 rentals. Our annual cash flow is $48,000. And again, this is very, very specific breakdown, so I can help you understand how the equity is built in each property. And if you look at the middle column here, principal pay down per year per property, okay, you see how it goes up each year, because again, each year you're paying, or in each month you're paying more in principal and less in interest. So in order to get, for unit 1, remember we purchased that one at the beginning of our first year, that has 7 years worth of equity pay down by our bookings. So again, we take year 1 through year 7 in that middle column, add that up, and that gives us the $34,098. And we add that to the $45,000 in down payment we put on the house. So now you can see in each unit, these are our total equity positions in each house, less appreciation. So it's not even accounting for appreciation in the left column. So if you look on the right side again, I break down the appreciation per year. Unit 1 is now worth about $358,000, 216, and again, units 4 and 5 after 1 year of appreciation around $309,000. So you add that up and subtract the $300,000 per house, the total amount in equity we've built in the house from literally doing nothing, just from the market moving forward, and again on average around 3%, you've built $132,139 in equity from appreciation and $304,230 from just equity alone and pay down from your principal, again, which is not paid from you, it's paid from your bookings from your guests on a short-term rental or from your lease agreement you have with your residents. So the total we've made, and this again, separate from cash flow, is $436,369 from doing nothing, which is amazing. So you can see how now this is starting to snowball, and we're going to get into, what if we had 7, 9, 10 properties, and you can imagine how it grows over time. And again, this is how you can create millions of dollars of wealth through real estate from not starting with a whole lot of money. So again, end of year 7 continued. We're going to look at the total amount of money invested per year to give you a picture, right? So remember back in year 1, we invested $65,000, again, of our own money, or maybe, we went in with a partner on this house. And year 2, we invested $0. Year 3, remember, we had $19,200 from our cash flow from our rental properties. So that means we only have to invest $45,800 out of pocket. Again, year 4, we don't invest anything. We just sit and collect. And year 5, $26,600 out of pocket, and then we have $38,400 from cash flow. Again, do no investments in year 6. Year 7, again, remember this is when we did the example of buying 2 houses, so it could be less if you just buy one and almost buy all of it from your the money you earned from cash flow. But if we buy 2 properties, it would be $72,400 out of pocket and $57,600 from our cash flow for 2 properties. Now again, over the years 2 through 6, you can see how we've spent less and less money out of our own pocket. So we've been able to save up the amount of money to buy those 2 properties by adding up our cash flow and whatever money we have to invest out of pocket. So if we were to do this, and again, it's going to be different for everybody. It could be 3 years for some people, it could be 15, 20 years for others, but the total amount of money that we've invested over this time, if you add up out of pocket, is $209,800. Now, total equity built in properties, which our down payment of $45,000 per property, plus the principal loan pay down by our guests each month, adds up to $304,230. And then if we add appreciation on top of that, that brings us, again, from the previous slide, $436,369. And then again, the total annual cash flow of $48,000 per year. And again, so the total cash flow earned thus far from our rental properties over the course of the 7 years is $163,200. This is awesome, and you guys should be getting excited about this. And hopefully not overwhelmed, because again, this can be taken as slow as you want or as fast as you're able to do it. But again, this is just a blueprint and breaking it down on a very specific, year by year basis to get there. So again, all right, we're still not at $1 million of net worth, and how much are we cash flowing? This is where it gets super exciting. And again, it doesn't matter if you're 20 years old, doesn't matter if you're 30 or 50 years old. When you get towards paying off the houses, this is where it gets incredibly exciting for all of us, okay? So again, right now we have 5 properties, cash flow of $48,000. Now, if you remember, each property conservatively around $9,600 per year from cash flow earned, net income from those properties. Now, if we have 7 properties, then annual cash flow goes up to $67,200. And each year thereafter, what's cool about this is you can buy a property per year or more with just the cash flow you've earned through your rental properties, which is incredible. And again, at this point, we've probably reached financial freedom, and we could even just sit on those properties and quit our jobs if we wanted and live how we want to live. And again, if you're hungry and want to build this even more, set you and your family up for further financial success, then you can keep going. So if we assume 10 properties, again, cash flowing the same, $9,600 a month, we're earning $96,000 a year in cash flow alone, not even taking into account equity and appreciation and all that stuff. Now, where it gets really interesting is over the course of 30 years, right? If we have a 30-year fixed rate conventional loan, that house is going to be paid off at the end of the 30 years, each one respectively. And not including appreciation, if the houses didn't appreciate at all, which is not going to be the case, you will have $3 million in equity sitting in those houses. And again, I was doing the math the other day on, okay, well, over 30 years, assuming 3%, each of those houses would be worth north of $700,000. And again, some of this is keeping up with inflation and market trends, things like that. But again, it doesn't matter. Your money is going to grow with the market versus sitting in a savings account or a checking account where it's not earning any money. You're actually losing money letting it sit there. So if it were to be around that $700,000 per house, again, that would be around $7 million in equity in the house. And that's not even where it gets super exciting. Okay, that's great to have that money saved. You know, your net worth is now several million dollars once the houses are paid off. But once the houses are paid off, we no longer are paying principal and interest on the house. Okay, so how much was that per house? And if you go into a loan calculator, amortization table, and do the same numbers that I plugged in based off of I think it was a 4.5% interest rate, that was $1,121 a month per house that was going toward principal and interest every month for 30 years. So once the houses are paid off, again, if you pay the house off early, great. If not, once it's paid off, you have the $800 in cash flow you were originally cash flowing, plus the new money that's no longer needed to go to the bank and it's now going in your pocket. So now monthly cash flow per house is $1,921. Again, multiply that by 10 properties. Your monthly cash flow for 10 properties alone will be $19,210. Now, that is pretty sweet, and I imagine most of you would be okay with retiring. Again, whether you retire at 30, retire at 70, it would be much more beneficial to have $3 to $7 million in the bank in equity within your rental properties and be cash flowing just shy of 20 grand a month. So again, if we break it down by each property per year, each of those is grossing $23,052 a year. So again, at retirement, whenever that may be for you, that would be $230,520 a year from just 10 rental properties at retirement whenever those houses are paid off, plus the equity in the houses, again, worth anywhere from $3 to $7 million, somewhere in there. So what would that mean to you guys if you could, retire, not having to worry about how much is coming solely from a 401k or an IRA or a savings account or some mutual fund that's invested in who knows what, you probably don't even know, and you're not paying money market managers or 401k management to manage investments for you. And now you own actual assets that are physical, the rental properties, and you're bringing in a net profit or net income, which also is taxed differently than W-2 earnings. Again, you can write the depreciation of your houses and expenses that you pay each year on those properties off against the net profit of $230K. So you're going to be paying significantly less taxes, which is awesome for you. Okay? So that is, again, the path to becoming a millionaire for many of us that don't have several $100,000s to invest today, but over the course of a few years, maybe we can save up or go in with someone else with similar interests and get in on one property. And again, it doesn't have to be $300,000. It could be $100,000 or it could be $500,000. And this is just an example of how to get there. And you guys, you can break this down however you want, but it helps you understand a clearer line of sight of, okay, where do I want to be in 10 years? Where do I want to be in 30 years, 50 years, whatever? What do I need to do today and the next year or two in order to start that process? And again, it's going to snowball over time. And with each house, you're going to get smarter. You're going to get better deals. You're going to probably increase the amount of cash flow because you're going to have a better cash on cash return or total return on investment, because you're going to find better deals and work your way through them. But that is it for today. Again, if you like these type of videos, please subscribe below. And I try to post about once a week, and the subscription is totally free. It's just a way for you to get notified when I post a video and you can see similar content. But that's all for now, guys, and I look forward to chatting with you guys next week. Thanks. Bye.